Yes, Kamali, the main factor affecting the global markets has been Wednesday's decision by the US Federal Reserve to keep interest rates on hold and its indication that they won't go up for the rest of this year. The European markets mainly dipped on the news. Germany's Deutsche Bank and Commerzbank were big fallers due to fears a merger could force Deutsche to downsize its US business. The FTSE is an exception, thanks partly to a rise in UK retail sales and reduced government borrowing. In contrast, mainland Chinese shares rose following the US interest rate decision, but concerns about the future of a US-China trade deal weighed on Hong Kong stocks. Talks are set to resume next week, but there have been mixed messages about their progress. US stock futures look mainly lower as they respond to the Fed's announcement. The central bank's approach to future interest rate hikes was more cautious than many had expected. Investors will be watching for unemployment numbers out later, as well as results from Nike. Oil prices reached their highest of the year in early trade, thanks to supply cuts from OPEC, combined with US government sanctions against oil producers Iran and Venezuela. Crude prices have risen almost a third since the start of 2019, but they have since slipped back off those highs. Well, for more on the markets now, Ranko Beric joins us from London. He is head of market analysis at foreign exchange company Monex Europe. Thanks very much indeed for being with us today. So let's start with some news that we've had in the last hour. The Bank of England gave its decision on interest rates, plus some thoughts on Brexit. What can we infer from that about the state of the UK economy?
Well, not a whole lot that we didn't know already. If I'm honest, the Bank of England really is on hold at the moment. We've got an economy that has a pretty tight labour market. If by any measure of labour market tightness, employment to population ratio, unemployment, wage growth, so on and so forth. The labour market is doing just fine. The economy has seen growth slow. The Bank of England would like to raise interest rates, but obviously we have this one massive uncertainty hanging over the economy. So until we have some direction on Brexit, we're probably going to see more of the same wait-and-see policy from the Bank of England.
And how have the European markets reacted to this uncertainty surrounding Brexit?
So I think the big theme this week really was the unwind of the last of the expectations for the major central banks to even get a whiff of policy normalisation at some stage in the next year or so. And for European markets, it's on the whole, it's likely to be reasonably good for growth. For the euro, it creates an interesting environment. We're likely to see volatility really on euro dollar begin to diminish to nothing. And probably investors are likely to look for carry trades in emerging market currencies, and the euro will resume its role as a funding currency.
OK, well, let's talk about the US Federal Reserve then. Two things came out of their meeting, their decision and their plans for the future. Talk us through that.
So really, the Federal Reserve came as a surprise for us. If you'd asked me a month ago, what's the Fed going to do, I would have said, look, they've really gone as dovish as is feasible in terms of their forward guidance. And yesterday, really, the Federal Reserve, I think, surprised markets by completely ruling out the possibility of any further rate hikes this year. And that's a very big deal because, again, we've got a US economy that has a very tight labour market that's looking like it's at the end of the cycle. You've got wage growth creeping up, and yet Jay Powell is saying, well, this isn't filtering into any upside risk to interest rates. So markets have taken notice of this. You've seen the dollar weaken, again, emerging market currencies performing very well as investors have sought higher yields. So really the question now is, will upside inflation risk begin to creep back into the US economy, and how will financial markets respond?
And how concerned should people be about the potential health of the US economy given this news?
I think it's, economists shouldn't be in the business of predicting recessions because it's a very hard thing to do. The US economy looks like it's going to slow back to trend growth, which is about 2% a year. So it's not a cause for concern. However, the amount of easing that the US economy has had over the past decade, the build-up in debt by a number of measures, is always going to raise some concerns of increased risks. The reality is, at the moment, we're not seeing any impending signs of a disaster, just a slowdown.
OK, Ranko Beric, who is head of market analysis from foreign exchange company Monex Europe, thank you very much indeed for joining us. Now to some other top stories from around the world. Zimbabwe's government has raised the salaries of its lowest paid workers by 29%. It's also allowing duty-free imports of vehicles for public workers and providing buses for their daily commute to work. public workers make as little as $470 a month, and they've been threatening to go on strike if salaries were not raised in line with double-digit inflation. Chinese internet giant Tencent reported the biggest ever drop in its profits. Net earnings plunged 32% to just over $2 billion in the fourth quarter. Its gaming business has been struggling to secure regulatory approval for the release of new video games. Revenues of its music streaming business also fell short of expectations. And British fashion retailer Ted Baker has seen its profits fall for the first time in a decade. The company says Brexit uncertainty has taken a bite out of sales, but investors are also nervous over the recent resignation of its founder and chief executive Ray Kelvin after allegations of misconduct. And you can tune into Money Talks at 17:30 GMT for more analysis of the EU Leaders Summit in Brussels and other business and economic news happening today. That is all from business for now, but here is Robyn Adams, who has the sport for us.